As you know, we will use financial accounting information as a point of departure for our evaluation. We will benefit from the standardized structure of financial accounting statements, and we will use it as a framework around which we will organize the entire forecasting and valuation process. In doing so, we will first discuss why is it that accounting information is actually a useful point of departure for valuation. Then we are going to discuss what in the form of the standard financial statements is not quite applicable for valuation and what we need to change or reorganize to make the standardized financial statements directly usable for valuation. Then we are going to discuss the most important distinctions for valuation. First, we are going to discuss the difference between operating items and financing items, and then we are going to discuss the differences between equity and debt. These categories can also be found in accounting, however, we may define them differently for the purposes of valuation. So let us first look at the question why we use accounting as a point of departure for company valuation. You know from the accounting class that financial accounting is essentially an information system that is intended to provide information for various investment decisions. And of course, the decision to invest in the company's equity, that is to say, to become an owner of a company, is one of the most typical investment decisions. The other, of course, being an investment into the company's debt that is made by creditors of the company. So you can say that if the way we do accounting at least partly meets the goal of providing information for investment decisions, accounting should be a useful point of departure for company valuation. In addition to the major aim of accounting to provide information for investment decisions, it has two appealing characteristics that will come in handy in valuing firms. First of all, accounting reduces complexity. It considers consequences of rather complex business activities and it reports their economic implications in a limited set of numbers. So even though we consider a firm that operates on several continents and runs several business segments and employs thousands of people, at the end of the year, we will see the consequences of their business reported in a limited number of numbers. Obviously, we live in the times of information overload. Information is abundant, but the key challenge is to orient ourselves in this ocean of information. And accounting will be one tool that will help us do that. In addition to that, accounting defines individual items in a standardized manner. That is to say that regardless of whether you are valuing a manufacturing firm, a retailing firm, or maybe a bank, if you look at the item that is called net income or earnings, it will represent a very similar category. And that is obviously very useful for valuation because before we start forecasting how the company will do in the future, we need to analyze its historical performance. And in doing that, it will be crucial to compare the company with other companies. And therefore, this standardization will make this comparison much easier. So these are two additional reasons why it is reasonable to use accounting as a point of departure for valuation. I have now argued that accounting is going to be a useful point of departure for valuation. However, that does not mean that accounting as it is presented in financial statements reported by firms at the end of the year will be a perfect point of departure. The most important reason for that is that accounting serves many masters. So if we again look at the formulation by the FASB of what we have accounting for, it says that accounting should be useful to present and potential investors, creditors, and other users. That is to say, there is not only one group that the accounting standard setters have in mind when designing the accounting rules. And therefore, some of the accounting structure will reflect the preferences of the other users, other investors that do not intend to invest in the company's equity. And therefore, we will need to take the accounting as it is presented or reported by firms, and we will need to reorganize it in such a way that makes it directly applicable and as a feed to the evaluation process. So to conclude, I have now argued that accounting has a number of appealing characteristics that will make it into a useful point of departure for company valuation. However, we will not be able to use the accounting in the raw form. Instead, we will need to transform it. We will need to group together items of similar economic nature and make it applicable for valuation from the perspective of equity investors. The most important dimension of this grouping will be the distinction between the operating and financing item. This distinction will be quite essential for determining the free cash flows, which is the major flow that we are going to discuss in valuation. If you look at the standard way that financial statements are reported by firms at the end of accounting year, you will see the distinction between operating and financing in it. However, not everywhere. More specifically, in the income statement, the revenues will be grouped into operating and financing, and also the expenses will be grouped between operating and financing. However, this distinction will not be visible as the first level of classification on the balance sheet. On the balance sheet, we have three main categories: assets, liabilities, and equity. And you can say that assets are classified into two main categories, current and fixed. Liabilities are classified into short-term and long-term, and equity is classified between contributed and earned. So you may say that the assets and liability classification mainly concerns the aspect of time. Is the asset or liability short-term or is it long-term? Now, this short-term versus long-term distinction is going to be important for other stakeholders, but is not going to be essential for equity investors, owners. And that is because if you value companies from the equity perspective, you assume long-term survival, so-called going concern, and therefore it is not absolutely essential to see which items are short-term and which are long-term. And therefore, for the purposes of valuing equity, we will need to overrule this default classification on the balance sheet and replace it with something that is better suited for equity valuation. And this brings me to my first question. I will ask you, first of all, why is the distinction between operating and financing items so fundamental for company valuation? Now, there are several reasons for it, and you are most welcome to discuss more than one of these reasons. And second, a practically oriented question, I want you to explain to me how to decide whether an accounting item should be classified as an operating or financing item. So, for example, let us say that I look at the balance sheet and I see the item labeled accounts receivable. Should I treat it as an operating item or a financing item? And based on what criterion will I decide whether this is an operating or a financing item? Again, there are several arguments, several points you can make about this question, and you are most welcome to mention more than one. The second key distinction that we are going to discuss is the distinction between equity and debt. That is going to be quite essential for determining the cost of capital. Now, you may say that the equity versus debt distinction is already present in the credit side of the balance sheet as it is reported by companies. But again, in company valuation, we are not necessarily constrained by the way accounting numbers are presented by firms. So again, we can overrule the default classification, something that better represents the economic fundamentals. And to be able to do that, we will first need to ask ourselves, what is the key distinction between debt and equity? What distinguishes the economic nature of the two forms of capital? To give you a hint, there will be at least two considerations that will differ between equity and debt. First of all, both forms of capital provide the investor some cash flow rights. So both creditors and owners will receive some cash compensation for their investment. But the nature of this cash flow will be different. The second are control rights. Owners and creditors will have different ability to determine what is going to happen in the company, to control the company. And these two dimensions will be the two most important economic distinctions between debt and equity. And this brings me to my second question. It has several components. First of all, I want you to discuss the key conceptual differences between equity and debt. And you are most welcome to use the two dimensions, that is to say the cash flow rights and the control rights, and explain how they are different for equity and for debt. Second, I want you to discuss based on what criteria should we distinguish whether an item that is found on the credit side of the balance sheet should be classified as equity or debt. And third, to implement this rule, please discuss how we should classify the following three items: preferred equity, minority interest, and convertible debt. So that is it for the upcoming lecture. I'm looking forward to your responses to my questions, and I'm looking forward to seeing you at the next lecture.